This morning from Nigeria's commercial capital, Lagos. Mr. Uche, back to our interesting discussion. So, of course, we were talking about your financial reports and we're talking about some of the fertilizer blending. Now, I wanted to also talk about your shareholder funds. In 2017, looking at those funds, the annual report stood at 501 billion naira, or the equivalent of $1.64 billion. Obviously, if you're using the 305 naira to a dollar exchange rate. It's apparent that your shareholder funds are stagnant. Why is that the case? And isn't this indicative that returns on investment appear to be very low?
Well, no. I mean, there are two ways to look at it. The first is obviously contributions have not been as strong as they should be, right?
Okay.
So we've had $1 billion, and then we had $250 million coming in towards the end of 2016, and then $250 million coming towards the end of 2017. So you need to look at it in terms of return on average assets, right? So the assets have not. So anyone looking at 2017, we didn't have 500 billion naira for all of 2017. Okay, so we had 1.2. Again, it's easier for me to speak in dollars because the exchange rate conversion is a little bit challenging for me. But $1.25 billion was what we started the year with. Okay. And then we received $250 million towards the end of the year. So you can't say, you can't use the snapshot at the end of the year. That's not really the right way to think about it.
Yeah, but $1.25 billion, how much had been used up before you got that 250 million?
So most of the year was $1.25 billion. Okay. Most of the year. We didn't have the last 250 until September. We didn't really put it to work until November. It takes a while to put that kind of money to work, right? So the easy thing to do is to simply use most of $1.25 billion for the year. Now, the returns on that is coming out, like I said, average of 7.6%. Okay. Right, which in dollar terms is not something to be sneezed at, right? It's not inconsequential, right, in dollar terms. And again, the three different funds have two different mandates. The stabilization fund is not expected to, the benchmark is 2%. Right? The benchmark is capital preservation in dollar terms, right? But we made more than that. Each fund has its own benchmark, right? So
you said you made more than that. How much more did you make?
We made about 6%.
Okay.
On the stabilization fund. Okay. Against a benchmark of 2%. Okay. Right? The Future Generations Fund, it made close to 8%, more than 8%. Sorry, about 8 points. I think it was 8.6%. I don't have the numbers right in front of me. I apologize. So. And it's 2017 we're talking about, right? Yeah, so this number's a little bit, you can always go back to the accounts and look at the numbers. Now, could that have done better? Yes. But the standard criticism on this job is very simple. Lose money, you're a fool. Make money, you didn't make enough, right? So that's standard. So I came into this job knowing that everybody has a right to be curious about that and make those statements. But when I took this job, one of my mentors, who had been the CIO of the Korea Investment Corporation, said this to me. He said, the standard criticism of this job of a sovereign wealth fund manager is you could never satisfy people on performance. You know, don't lose money. But if you make money, no matter how much money you make, it's not enough. But in aggregate, that I don't think is something to sneeze at. Now, it's not top quartile. It's second quartile in terms of when we look at our peers. Because the real challenge of this job, frankly, in a market that's quite volatile. By the way, 2018 is turning out to be a hell of a lot more volatile than 2017. Absolutely. This same year, the US stock market made record highs. And then this same year, in two to 3 weeks, it lost everything. Exactly. Right? It's an incredibly volatile market. And so holding stable sometimes is actually not a bad thing. And it's a lot more challenging than you think.
So are you saying that part of our assets are invested in the US stock markets?
Some. Some, yeah. 10% of the FGF is in developed markets.
Isn't that too volatile?
It's an asset allocation that we agreed and published and said this is what we're going to invest in.
But why don't you invest in bonds which are safer?
Are they? What makes you think they are?
They are safer. Now, you mentioned your accounts.
No. Let's go to that for a minute, right? Okay. This is what happens to bond prices. Okay. In a rising interest rate environment, bonds tend to collapse in terms of valuation. Do you know that? And then two, if you invest in a corporate bond and the company goes bankrupt, it's the same risk. So the point I'm making is that it's safer than equity.
With stocks, the risks are too high.
Yeah, with stocks, the risks are too high, but it's a small allocation. So there's a sovereign wealth fund that's the biggest in the world. The asset allocation is on the website. 60% is in stocks. We are 10% of Future Generations Fund. So it's quite small, but you need to have some exposure there because last year, for example, our emerging market equity investments made as high as 25%, right? Okay. I know the risk is high, but you also have to have, that's why diversification is important. So a little bit of this, a little bit of that. We have some bonds, we have some hedge funds, we have some public equities, we have some private equity. So all of that is what created a diversified asset pool, in my opinion, that I think it's actually been helpful for us.
Okay, now, earlier you mentioned your accounts. Your accounts also showed that the stabilization and the future generation funds, all the investment fund managers used by the NSIA are foreign, save for the Africa Capital Alliance and one or two others. Why is that the case? Do you not have confidence in local fund managers? And how will we build capacity if we depend solely on foreign investment managers?
So let's go through that, right? Stabilization fund is mostly outside of the country. You can't stabilize with your local investment. You stabilize with what you have outside of the country. Our intervention currency is the US dollar, so we try to preserve value in US dollar terms. So that's stabilization fund. On the Future Generations Fund, we actually have more exposure than what you have there. We have 6 Nigeria-based private equity managers. The NSIA is on record as being one of the biggest supporters of local private equity capability. We've backed almost every single fund that's local: Synergy, Verod, ACA, Helios. You can name all of them. Cardinal Stone, we're in all of these funds. They're all at different stages of their investment. They're all calling capital at different stages, small amounts, big amounts, but they're all part of our stable of our asset managers. So one of the things we really want to accomplish in the NSIA is actually helping create this capital pool of private equity. Because I think that's a big missing piece in our entire capital structure in Nigeria. Most companies that don't have enough equity. So we're backing all of these companies, and helping them raise capital from outside of the country. So it's not correct to say we don't have any confidence in them. We do. But again, our threshold is extremely high. This is not charity, okay? This is real money that tomorrow, if I lose
that has to be commercially viable.
You're going to be...
But you can only raise this threshold by making sure that we have local foreign managers.
Oh, we do. We do. Like I said, there's hardly any local private equity fund today that's passed our due diligence that we haven't backed. Hardly any. Like I said, I mentioned about 6 of them. And they're not too many, to be honest.
They're not too many?
No, they're not too many in this country. They're not. I think there are about 8 of them.
Okay.
Or 9.
And you've mentioned 6?
Yeah, we've made 6 of them that we've backed, yes.
Okay. Well, I want to talk about Twitter, because nothing is as interesting until you introduce feedback that you're getting, of course,
which is great, by the way, yes.
From the Twitter nation. So yesterday, the former managing director of the Asset Management Corporation of Nigeria, Mr. Mustafa Chike Obi, criticized the Nigerian government for issuing bonds at average yields of about 9%, adding that the NSIA, with holdings mostly in US dollars, reported returns of about 4% in 2017. Now, he went on to wonder why the NSIA was not investing in Eurobonds and why the government was borrowing at 9%, thereby saving 4%. What's your response to his question?
Sure. I mean, I think, first of all, there are 2 mutually exclusive arguments, and bringing them together in one tweet. That's the problem with Twitter. I don't tweet because it's really difficult to sometimes not come across.
But that's the great part of it.
No, but that's a fantastic part of it, but we'll come back to that in a minute. So there are 2 mutually exclusive arguments. One is borrowing at 9%. 2 is what the NSI is returning. Why is the NSI not investing in it? I think that's just the conjunction that's a little bit difficult for me that I'm going to address in a minute.
Okay.
First of all, it's a fundamental misrepresentation of the fact to say we earn 4%. It isn't. I can explain to you.
Okay.
You cannot take a snapshot at the end of the year. Every basic accountant knows to use return on average assets, not at the end of the year. You didn't start the year with 500 billion naira. You started the year with less than that.
Okay.
So as the capital came in, and as I explained to you, most of the capital came in towards the end of the year. The new capital came in towards the end of the year. So the real number is higher than 4%.
Okay.
2, we manage money for the federation, not the federal government. Whether we invest in these assets or not is an exclusive reserve of the NSIA. 3, the federal government borrowing money at 9.25%. We've just been through a world of rising interest rates recently. It wasn't the case for most of the last 4, 5, even 10 years, to be honest. So there's a new president of the United States, and they're pushing for high interest rates, there's trade war, all kinds of things that lead to high yields.
Of course.
So it's not just an experience on the federal government of Nigeria, it's an experience that you're seeing across most of the countries in the world.
Board, yeah.
Emerging markets in particular. Look at Turkey, for example. Look at Argentina, right? Yields are like, at a point it was almost 25, 30%, in some cases 40%. So there's a rising interest rate environment that I think is a challenge for most emerging market economies. Now, so I've dealt with the fact that the returns are not 4%.
Okay.
Take a snapshot at the end of the year. Different funds, different mandates. Look, I'm investing in healthcare. We're investing in Second Niger Bridge. For the first 3 or 4 years, it's not going to make any money. It's probably going to lose money before it starts to make any money. So you can't just take that snapshot. It's really not the right thing to do. It's not, frankly, with respect, it's not a smart thing to do.
Okay.
The way to look at it is take an average. And then back to whether we're investing in Eurobonds or not, you know, it's up to our board and management to decide whether it's the right thing for us to invest. And we've owned corporate bonds in Nigeria, by the way. We have. So it's not outside of our remit to own it. But at the same time, like I said, each of the funds that I described have different mandates. Some of them might be able to invest. Some of them might not be able to. The infrastructure fund may not be able to invest. Yeah. The future generations fund might be able to invest up to a certain amount of money. We're looking at it, you know. But you can't. I'm sorry, I can't go any further.
You can't ask it as one question. Is what you're saying.
You can't. You know. But I also think, like I said, there's a standard criticism about returns for every sovereign wealth fund. You never make enough money, and if you lose money, you're a bloody fool. And I think what we're trying to avoid here is just making sure we don't lose money. Or
just making sure you're not looked at as a bloody fool.
Exactly. And ensure that we're earning returns that are, you know, at least on par with some of our peers. We're in the second quartile returns, which is, it's not great. I like to be top quartile, but, you know, there's a lot of work that's involved in getting there.
Of course. Okay, well, anyway, the NSIA is a signatory to the Santiago Principles, which provide for the generally accepted principles and operational practices for the sovereign wealth funds around the world. Now, however, in terms of asset size, Nigeria has one of the smallest wealth funds, and we have oil. So does this stem from the lack of political will to save excess proceeds from crude oil sales by the Nigerian owners of the fund, which is obviously, you know, the federal government, the states, and local governments? Sure. And what needs to be done to grow our fund for future generations?
I agree with that. In terms of the size of the NSIA relative to the size of the GDP of the country, it's very small. It is very small. And I think very soon the argument that we started late is going to wear thin. And so there must be a commitment to investing and, you know, growing the sovereign wealth fund. The real kicker for any sovereign wealth fund is the consistency of contribution. It's not that you started with $1 billion. It's static. That's not going to help you, because we also have 3 mandates, you know, so it's future generations, it's stabilization, it's infrastructure. By the way, we're probably the only one with those 3 mandates. Most other sovereign wealth funds have 2 mandates: stabilization, future generations, that's it. Okay. None of the other sovereign wealth funds that I know
are focused on infrastructure.
Domestic infrastructure in particular. Yeah. It's a whole different skill set to manage and invest in that area. So, and that means that for the NSIA, and it has nothing to do with whether a manager or somebody else is managing it, for the NSIA to fulfill its mandate, it's all about consistency of contribution. The other sovereign wealth funds you have mentioned, many of them go back. The Abu Dhabi started in the 70s. Qatar started in the 50s. Okay, and for a long time you heard nothing until they got to a certain size. So I agree with you, by the way, that, you know, there must be a consistent approach to investing in the sovereign wealth fund. And the impact should be measured in decades, in my opinion, because that's really the people you're comparing them to. Today, you're comparing them, you know, after 30, 40 years of savings. We must, but you must be consistent, you must start. And I think is something that we need to really address as a nation. Well,
Uche, it's interesting that you mentioned Abu Dhabi. We noticed, like, countries like the United States, many states within the United States have their own sovereign wealth funds,
Alaska,
like Texas, Alaska, North Dakota, and so forth, and Utah. Now, interestingly enough, doing research, we found that in Nigeria, Bayelsa has followed suit by having its own sovereign wealth fund, worth $1.5 billion. How true is this?
I don't manage it by a sovereign wealth fund, so I probably.
So you don't know if you can.
No, I know that they have a program, and I was personally consulted when it was being started. I don't know the size of it. I mean, it's only the manager that can tell you the size of it. Okay. By the way, most other sovereign wealth funds, particularly the Middle Eastern ones, you don't know the size of them, do you?
No, I do not. Well, finally, would the NSIA consider issuing guarantees to investors who want to get involved in infrastructure projects to fund those projects?
The answer is no, because we're explicitly forbidden from providing guarantees in the NSIA Act, the NSIA law. But having said that, we've done something that I think is really something that, you know, you should focus on someday. We created a company called InfraCredit.
InfraCredit. Okay.
InfraCredit is a company initiated, sponsored by the NSIA, and in conjunction with Garantco of the UK. The job of InfraCredit is provide bond guarantees for infrastructure bonds. So it's going to do 2 things. One, it's going to develop the bond market, and it's also going to develop the infrastructure bond sub-market, frankly. Because at the moment, people that want to build infrastructure go to banks. 3-year money, 4-year money, interest rate in the 20s doesn't help. If you have a good project that can benefit from an enhancement on your bond, we can help you drop the interest rate substantially. So I'll give you an example. The first transaction we wrote about a year ago, towards the end of last year, we took the interest rate of that company down by almost 8 percentage points.
Oh, wow.
10-year money in Naira. And that was because InfraCredit provided a wrap, what is called a wrap, like an enhancement.
What's a wrap?
It's a guarantee. It's a guarantee. It's a technical way of calling it a guarantee on a portion of the bond that they raised. And once we did that, pension funds, insurance companies were able to invest in that bond. So this is a company, again, that was incubated in NSIA. Now it's an independent company. It's operating in the next 6 months. But the idea is for this company, with its guarantee, to get latent pools of capital like pension funds, insurance companies, to invest in infrastructure bonds. We have tenure elongation, which is the biggest challenge infrastructure have. I'm just telling you, the shortest thing we've done is the healthcare projects. And those took 18 months to 2 years to build. If you're taking money on a 3-4 year basis, you can never succeed doing that. So we believe that 5-10 year money is what you need. And then we've taken the interest rate of this company from mid-20s to high teens, to low teens, and mid-teens. And my sense is that the more of this we can do, the more we can create a guaranteed structure for high-quality infrastructure programs in the country.
Uche, thank you so much for joining me today on the Global Business Report. It's been a pleasure having you.
Thank you.
I've been talking to the Chief Executive of the Nigerian Sovereign Investment Authority, Mr. Uche Orji. That's it for this edition of the Global Business Report. Please keep it here on Arise News. But for now, on behalf of the teams here in Lagos, as well as London and Johannesburg, thank you for watching.